This is David Luna, President of Mortgage Educators in Compliance, with your updates for the interest. More and more sentiments are growing that there will be an increase in the Fed funds rate November 1st. We've heard hawkish comments from Federal Reserve Chairman Jerome Powell. But what do the other members of the Federal Reserve think and feel about a future rate hike? Vice Chair for Supervision Michael Barr, quote, "The Federal Reserve may need to raise interest rates one more time this year before holding them." Federal Reserve Bank of Cleveland President Loretta Mester, "This move will, quote, depend on how the economy evolves relative to the outlook," close quote. And the results of the Fed's actions, quote, "I foresee inflation declining to about 2.5% next year before closing in on 2% in 2025, said John C. Williams, President and CEO of the Federal Reserve Bank of New York. Most of the 19 Fed officials anticipate one more rate increase for this year. If we look at the Wall Street Journal, their estimation is also, yes, rates will go up one more time. But I think the real question is, what will this do to mortgage interest rates? I believe that most of those rate increases have already been baked into the rates we are seeing today. Lenders have about 324 basis point spread, which is way above normal, already baked into their pricing. Normal is 170, 175 basis points, meaning that rates should not increase suddenly after the FOMC meeting. Doug Duncan, chief economist for Fannie Mae, answering the question of why rate spreads are so wide, said, quote, "No fixed income investor thinks that mortgage-backed securities with 7% mortgage rates will be there when the Fed finishes the inflation fight. They're going to cut rates, and that will prepay. The Fed is not an economic buyer. That is, they aren't buying for risk-return matrix. They are buying to affect the structure of markets, so they are a policy buyer," close quote. The country dodged an economic shutdown this past weekend, and then rates went up. Why? When there is bad news, it is good for interest rates. Positive news does the opposite. So now that a potential crisis has been averted, rates reacted by going up. But this was just kicking the can down the road a little way. By mid-November, Congress will have to deal with this situation again, meaning what happened last weekend was just a temporary fix. The Mortgage Bankers Association wrote in a recent analysis, quote, "A shutdown lasting a few days would suddenly inconvenience lenders in processing loans. However, a longer delay would have more severe impacts," close quote. Add to that, the possibility of a Fed funds rate increase will make November a very interesting month. For the interest, this is David Luna, President of MEC.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.